Hey guys, welcome back. Now, one of the most important parts of investing is knowing where to put your money, also known as asset allocation. Many experts agree that asset allocation is probably the single biggest factor that will determine your investing success. So, pretty important stuff, right? Yet what I find quite surprising is that this is such a critical part of investing, yet I rarely see other big YouTube finance channels covering this topic. I guess it's not quite as sexy as saying, this is the next stock that is going to 10x. So for this reason, I felt I had to share some of the key concepts and principles I have learned to help you guys with your own asset allocation. Now, the million-dollar question is this: what is the perfect portfolio allocation? Well, unfortunately, it doesn't exist. The truth is that it's going to be different for every single person, as there's several factors that we need to take into consideration. So in this video, we will be covering the objective of investing. What is it that we're actually trying to do? We'll look at the 7 main asset classes. These are all the different places that you could be putting your money. The risk curve. This is such a crucial piece, and you will need to decide where you sit on the risk curve. And then we'll finish with some example portfolios from some billionaire investors, and I'll also include my own. So this will all begin to make sense. As always, if you do find anything useful in the video, be sure to drop a like. Always very much appreciated. Okay, so the starting point is getting clarity on what it is we're actually trying to do. Check it out. What is the actual objective of investing? Well, if we break it down to its simplest form, it's essentially using money to make more money. And so by doing this, by default, we are putting our money at some kind of risk. So the equation is always, what's the risk-reward ratio? I think we're all pretty good at knowing what the reward is and making money, but 50% of our time should be on analyzing the risk. So what are the 7 main asset classes where you can put your money to work? Let's begin with stocks, and you can do this in many different ways depending on how much risk you're willing to take. This could be index funds or ETFs, it could be individual stocks, or you could be buying on margin or using puts and calls. We have bonds, and again you could go super safe with government bonds or venture out to corporate bonds or even the high yield junk bonds. We have property, and this could be residential or commercial. It could be a single unit, multi-unit, apartment buildings. We have cash and cash equivalents. So this would be money in the bank, but this would also include short-term bonds, CDs, as they can be quickly liquidated into cash. We have commodities, and the 2 most famous will be gold and silver. Or if you have the knowledge, you could venture out into oil or copper or many other commodities like sugar, wheat. We have the brand new kid on the block, Bitcoin, and now the other cryptocurrencies. There's now about 9,000 to choose from. And finally, we have alternatives. So there are many things that fit into this category. Some people like to collect cars. It could be watches. It could be artwork. We now have the NFT market, or even something quite niche like Pokemon cards. But essentially, these are the different places where you can put your money to work. Now, I get comments every single day from people saying things like, should I buy this particular stock? Or should I buy this particular ETF? Or is it too late to buy Ethereum? Or should I be selling my stocks now? And unfortunately, it's always impossible to answer these questions because it depends on several factors and where you sit on the risk curve. Now, the risk curve is something that you're going to want to spend a lot of time on and master, and I will refer to it again and again and again because it's such a crucial part to investing. Check it out. So this is the risk curve, and essentially it's made up of 2 parts. You've got the potential reward, and yes, it's potential as nothing is really guaranteed, and how much risk you are willing to take. And you will need to decide as an investor where you sit on this risk curve. And the reason it's different for every single person is that we all have different situations. Some people have a high income, some people have a low income, some people may have lost their job, some people may have just got a high paying job. We have the size of the portfolio. A $10,000 portfolio is probably going to be very different to a $100,000 portfolio, which is probably going to be different to a $1 million portfolio. Everyone has a different risk tolerance. There are some people that just don't want to take a lot of risk. And there are people that are happy to take more risk to get more of a potential reward. We all have different objectives, whether it's we're trying to double our money in the shortest time possible or build a solid retirement. We all have a different financial knowledge. How much do you know about stocks, about the different bonds, about the different commodities, the different cryptocurrencies? And then remember, we all have our own personal opinions and biases that we sprinkle over the mix as well. So we can do this on a portfolio level, but we can also do it on an asset class level as well. Take stocks, for example. Now, you could just invest in an S&P 500 index fund. You'd be sitting around about here. You'd have a lower potential reward, but you're not taking that much risk. If you hold on to it for 10 to 20 years, you're virtually guaranteed to be making money. You can head further down the risk curve if you want to start picking your own individual stocks. You can make a much potential bigger reward, but you are taking more risk that an individual stock can go out of business. And you can head all the way down to things like penny stocks, where you could be making 100x on your money, but again, this is very risky. You can do this with bonds. You can stick to government bonds, which is one of the safest places to put your money, as the government is very unlikely to go out of business. You can go for the big corporate bonds, or you can venture out to the high yield bonds. It works with gold and silver. So gold has a 5,000-year track record. It does go down, so you're taking some risk, but over time, it's always held its value. Or would you head out and maybe take on silver? You're taking more risk, as silver is a lot more volatile, but you get a potential bigger reward. You can do this with cryptocurrency. So Bitcoin is the equivalent of the blue chip company in crypto. You could venture out a little bit with Ethereum. You can venture out and start playing around with a lot of the altcoins in the top 100. You could YOLO on Dogecoin. Or if you want to go down to crypto number 4,000 and go all in, yes, you could get 100,000 times your money, but you're taking an incredible amount of risk. And the other part of this whole thing is on a portfolio level. So a portfolio 100% in bonds would be down here. If you wanted to do 50-50 with stocks, if you wanted to add in some commodities, if you wanted 50-50 with cryptocurrency, or if you're younger and don't have as much money, you can do 100% in cryptocurrencies. And the reason this is so important is that it answers all the questions. Should you buy this stock? Should you sell this cryptocurrency? Should you move into this fund? Well, it all depends on where you want to sit on the risk curve. So we know the objective of investing is using money to make more money. And by doing that, we are essentially putting our money to some degree of risk. Now, the whole idea behind building a portfolio that is diversified is that it lowers your risk and also the chances that you could lose everything by putting all your money in one place. So the $1 million question is not what is the perfect portfolio, it's what is the perfect portfolio for you. Well, there are two main options. You could go to a financial advisor or money manager and they will work with you to do this. Or you could learn how to do this yourself. And as an investor, this will be something that you're constantly working on and improving over time. One of the best ways I know to answer the question, where should you put your money, is to get lots of different reference points. The more portfolios of other people that you see, the more it will begin to make sense. So one of the best things you can do is start analyzing the portfolios of other people, other big investors, other YouTube finance channels, friends, colleagues, books. Think of a table with only one support. It's at risk of falling over, as it only has one reference point. But a table with hundreds of reference points becomes a lot more stable. And this is why you should never just copy off one person's portfolio, as you don't know their full profile. Okay, so to get started, here are some portfolios of some billionaire investors like Warren Buffett, Ray Dalio, Jack Bogle, and I'll also include mine at the end. Check it out. So first up, we're going to start with the man himself, Warren Buffett. And he advises for the vast majority of people a 90-10 split. 90% in stocks and 10% in short-term government bonds, or this could also be cash, as this is a cash equivalent. And Warren Buffett recommends a low-cost S&P 500 index fund. And there's always pros and cons to every portfolio. So this portfolio suits a wide range of people. Young people, middle-aged people, a low amount of money, a high amount of money. If the stock market's going up, then you do really, really well. If there's a big drop or crash, you've got money to deploy. And this would also make an excellent portfolio for a complete beginner. Warren Buffett doesn't really invest in properties. He doesn't like gold. He's not a fan of Bitcoin or cryptocurrencies. But remember, this is the world's most successful investor. Next up, we have Robert Kiyosaki from the Rich Dad series. And just to be clear, he's never actually publicly stated what his portfolio is. But I'm very familiar with his work. I've read most of his books, seen lots of interviews, so I've pieced together what I think his portfolio would look like. Now, we do know that he's got thousands of units of apartments. So his portfolio will be heavily dominated by real estate. He likes the leverage, he likes using debt to get rich, and you get really good tax advantages. He's said in public many times that he doesn't invest in stocks. So 0 stocks in this portfolio. And he is a fan of hard assets. So real estate. He does really like gold, silver, and he's recently been buying Bitcoin and Ethereum. And you can see just how different this is to Warren Buffett's. Next up, we have Jack Bogle of Vanguard and the creator of the index fund. And for the vast majority of people, Jack recommends going 100% in stocks for the vast majority of your life. He wasn't really around for cryptocurrency, he wasn't a fan of gold, and he would invest in a total stock market index fund, ticker VTI, which is very similar to an S&P 500. And as he got into retirement, he then moved to 50% in bonds. And this helps reduce the risk, so if there's a stock market crash, he doesn't lose everything, and this was his retirement portfolio. We then have the famous all-weather portfolio from Ray Dalio, and this is a portfolio that's been designed to do well in all scenarios: economic growth, economic decline, times of inflation and deflation. So you can see this is really heavy into bonds. There's a nice strong stock position. He is a fan of gold and also a commodities index. And this is not really an accumulation portfolio. This is probably for people moving into retirement, or if you've got a large amount of money, this is more how you protect your wealth. And lastly, I'll show you mine. As you can see, it's now over 50% into crypto. We have 33% in stocks and 15% in cash. Now, from an outside point of view, this looks like a very risky portfolio. But here's another important lesson. You always need to make sure that you see the full picture. So this in fact is just the liquid portfolio. When you include the personal residence, which is the net worth, you can see almost half of it is now in property, which is very, very safe. I spent quite a few years really paying down the mortgage, so I have the largest part of the money that is pretty safe. And that means with the rest of my portfolio, I can be more aggressive further down the risk curve to try to capture bigger gains. So always ask the question, are you seeing the full picture? So there you are guys, lots covered, and let's bring all this together. The objective of investing is using our money to make more money. By doing this, we are essentially putting our money at risk, and so you need to decide where you sit on the risk curve. The 7 main asset classes were stocks, bonds, crypto, cash and equivalents, commodities and alternatives. The more portfolios you see and analyze, the more this will all begin to make sense and you'll know what is right for you. And a great place to get started would be a low-cost S&P 500 index fund in a tax-efficient wrapper. And from there, you can build it out. Obviously, there's so much more we could cover, but this was just to give you a high-level overview of some key concepts and principles. So I hope you found this useful. And with that being said, just one favor to ask. If you did find anything useful in the video, be sure to drop a like, and a big thank you to everyone who does. If you haven't yet subscribed to the channel, I invite you to click below and join us. I do have some great videos coming up that you don't want to miss. Also, please be careful guys, I do have someone cloning my site and pretending to be me. Just know I'll never ask you to buy anything in the comments, and I'll never ask you to text some dodgy WhatsApp number. Okay, cheers guys, thanks for watching, and I'll see you in the next video. Bye for now.